Trading Without Fear. This episode I'm going to be talking about my favorite pattern, the ABCD pattern, and why I think it's the #1 best pattern for new traders. So let's go ahead and get into it. So this right here is a chart of CEI, and this is September 3rd. Now I'm using TD Ameritrade's on-demand feature, which is a really good tool to use if you're trying to learn a new strategy, or if you're trying to identify patterns. You can go back onto specific dates and times, and you can kind of trade the stock using paper money, and it's a really good way to identify any sort of strategies that you're trying to learn. So right there, I just put in a fake paper trade, so I have a -90 shares. So right now I'm kind of getting, I wouldn't say I'm getting squeezed, but I'm starting to get a little bit of a loss. But you can see how this works. It's a really good way to actually learn to do something with very little risk, and you can do it outside of market hours. So I really do like this tool as far as using it for educational purposes. So going to ABCD pattern, I'll be showing a couple of different examples of this, explaining where I'd be risking off of, why I'd be risking off of that. And there's a couple of different variations of an ABCD pattern. Some people call them the gun pattern, the ABCD pattern. Some newer traders right now call them spike, consolidation, spike. And they're also known as a wedge pattern as well. So basically this right here is an ABCD pattern with CEI. It's a former runner. It had a nice big push up through here, spiked up after or pre-market and after hours. It kind of went up again and consolidated for a day. So some people would also consider this a third day surge, where it takes a rest, and the next day, on the third day, it opens up and kind of holding those levels. So that's basically what it's doing here. It kind of dips down, creates a lower high, and tries to reclaim that. And when it comes back down again, that lower high kind of acts as support. And over time, what ends up happening is that support becomes a little bit more of a lower high, starts to squeeze back up towards VWAP. Now in this particular trade, if you didn't buy it down here at the 69, you can buy it at the 70, and you'll be risking a B. Now it depends on what the actual chart is and what your risk tolerance is and how clean the chart is. It determines where I would choose where my risk level would be at. In this particular trade, I'll be risking off of B, which is the low of the day, and it's about 2.5% on this trade for the potential upside of around 38%. Now that's one of the reasons why I do like ABCD patterns, is there's a huge upside potential as long as you can hold on to it. So some of the things that a lot of newer traders end up doing is they oftentimes will actually buy the breakout of A, and there's a couple of different reasons. I'll go over some examples of why that's kind of risky to do. And what ends up happening is when they, if you buy here and you start to sell your shares up here, so you're taking a quick 5% profit, it's really hard for a lot of newer traders to kind of hold down to this downwards trend. And what they're starting to think is that the breakout didn't work, the market is going to take their money away, and what it's trying to do is establish another higher low. And so once it has that clean breakout over 70, what we want to see it do is hold that breakout and act as support. So then sometimes it can consolidate for a while before they continue upwards. In this instance, it ends up holding that support for a couple of minutes, starts to ramp up, and it kind of does the same thing, consolidates, ramps up, breaks down, consolidates, ramps up, and just kind of does this stair-stepping pattern all the way up to its high of 95 cents. And so that's CEI's pattern. And this right here is an ABCD pattern. It's on a longer term time frame. You can see that nice morning spike here, hold back to lower high. Now, this particular pattern right here, this is one of the reasons why you wouldn't want to actually buy the top of the chart. So let's say if this was an OTC trade, or there's a much wider range on this. If you're to buy the top on this right here, and you're to buy it here, it kind of breaks out just for a little bit, and then ultimately starts to run down and down. Now, if you're doing the proper risk, you're probably giving it 2%, 3%, whatever. You'll end up kind of trade for a small loss, which is something you're supposed to do is always make sure that you're cutting your losses quickly. But what you ended up doing was not realizing that the better part of the trade to actually buy into would have been during the parts of the moment of consolidation. So on this particular chart right here, it ends up having a morning push, pull back, makes a B, starts to have a lower high, stays above VWAP, and when it comes back and tries to retest that, you can buy it pretty much anywhere around this area. And with this particular trade, because I work off of percentages, I'd be risking off of B, which is about 3.5%. And at this particular time, it ends up going to only about 5% from here to here. And when I'm looking at it as a risk down here, if I'm risking, this B area here, throughout the day, what it does is starts to hold that trend. So there's another lower high here, another lower high here, another lower high here, another lower high here. And that trend kind of just holds throughout the entire day. Ultimately, what it ends up doing is having a breakout later on near the afternoon. Now, ABCD patterns can take a lot of time to actually form in the markets. They can also take a lot of time to work in the markets. Depends on the market condition and depends on the stock. Sometimes they'll work within a couple of minutes and you'll be up 10, 15, 20%. Sometimes they take all day long, and then all of a sudden this massive breakout happens at the end of the day. And I'll be showing you an example of that here soon. And so this technically here wasn't a failed ABCD pattern. It just didn't so happen to push through in the morning. And the great thing about ABCD patterns is they can form at any time within a day, and they can also form multiple times in the same stock. So with next example is KPLT. So this is another example of an ABCD pattern. You can kind of understand why some people would call them a wedge pattern. And so this one has a nice breakout or a nice push in the morning, pulls back, makes a low, pushes through again, pulls back, doesn't hold that support level, cracks down, makes another low, makes a lower high, starts to consolidate and squeeze up towards this VWAP area. And if you didn't buy it in this VWAP area, you could also buy it when it breaks out of this range right here, risking just below C. That'd be about 4.5%. On this particular trade, I would be risking off of this lower down here, just because this trend that is created with this would be broken. And by risking down here, to me, it's just an unnecessary risk, which is why I risk down here off of the low C. And on this particular trade, the upside potential is about 20%. So for a max risk of about 4.5% for a 20% profit-ish, that's not too bad. We want to cut down the middle and just say 15%. So 5 to 15, still not bad. So this is one of the examples that I was talking about where it takes a long time to kind of work out, and ultimately it does a really good push. So on this particular trade, it went from $10 to $14.09. So you have a potential of around $4 a share on the upside, and the potential risk of maybe 4% on this trade. So 4% of the potential of making $4. And this particular trade just ended up taking a long time to consolidate. The longer term chart didn't actually show any price action or anything like that on that day. So for a long time, it's just barely above this breakout level or kind of equal to that breakout level. So again, some of these may not pop up on your, high top percent gainer scanners. I didn't see this particular trade until after the fact because it was holding so close to the breakout level, and I did adjust my scanners because this was probably only up like 5%, 3% before the big breakout happened. So I did put this, change my scanners because of this type of a move. But you can see how it has that nice push up in the morning, pulls back and makes a low, lower high, lower high. I'm going to zoom in. So lower high, starts to slowly squeeze its way up towards the VWAP. And traditionally, you want to actually put a trend line up in the top like this. The only reason why I did it so that way you guys can see what I'm looking for on these is where it's starting to tighten up towards a specific key level, and this particular key level was right here at a 1031. And if you could break out of that 31 range, there's a good chance I actually squeeze the high today and continue going forward. Now, one of the reasons why the ABCD patterns work, especially in the listed stocks, is because what it does is it suckers in shorts. Shorts see these, and they also think it could be creating a lower high, and they kind of start to short into it, and ultimately kind of is a battle between who's going to win, the shorts or the longs. And if there is enough shorts in there, they can squeeze it pretty big. If there's not enough shorts in there, they end up getting stuffed pretty easily. The volume dies, and the whole pattern just kind of falls apart. So let me kind of show you what that looks like on a failed ABCD pattern. So this is going to be BTCM, September 3rd. And with BTCM, it was having continued momentum from the previous day, and it kind of just consolidated sideways during after hours and pre-market. During pre-market, had a nice breakout of that $13 range and started to form the same ABCD pattern. Now, this particular trade I did get into, I bought it at $13.97. So right around here, I was anticipating it kind of breaking up through 4 and continuing on. And once it ended up, coming down and changing trend, I ended up cutting it at 1342 for a 3.94% loss. So basically, at this candle right here is where I cut it at. And so I ended up buying it around here and ended up cutting it down here. So my thought process on this trade was there was a really big consolidation at this level. I thought perhaps that consolidation could act as support. If it failed support, then I'll be willing to take the loss and get out. And in this particular trade, it never actually reached the high. And it looks like it tried to push through it once as soon as the volume started dying. Maybe there wasn't enough shorts in it, whatever the case was. The trade ultimately didn't broke trend and started coming down. Now, if you're going to be a subjective trader and you're trading ABCD patterns, the best time to actually cut the ABCD pattern is when the trend changes and confirms that change. So in this particular chart, if you see how it's starting to make a low, lower high, lower high, lower high, comes back, retests this trend line right here. Once it kind of falls down below that, the probabilities of this trade not working is pretty great. And even if it does set up, because sometimes they will set up later on and kind of form it again, you can always buy it back in. It's always better to protect your account versus taking a much bigger loss, anticipating something more. And let's say if you were to have done that, your risk would have been about 3% if you would have gone on the absolute lowest part. So if you're waiting to see if if it's going to reclaim VWAP and it fails, you can cut it down here, and your risk is about just over 2%. So that's one of the great things about ABCD patterns. There's definitely key levels on the chart where you can see and clearly identify where you'd be risking off of. And so this trade right here is Annie. It's going to be on September 2nd. This is a former runner. And here's a really good chart pattern of an ABCD pattern where it ramps up in the morning, pulls back. Normally I wouldn't be buying into something like this because to me there's no risk. I mean, you could be risking off here, but there's no direction of what direction the trade's going to go. I mean, if you were to buy here, you can just sell into that pop, but by waiting for a little bit of time to actually see the consolidation, to see the uptrending and the curling action, it gives me a little bit more conviction of where I want to buy, where I want to risk. And as it's starting to get closer and closer to this breakout level right here around 950, the best area to be buying at is either about $9, or you can even do the 950 range. And your risk on this chart will be just below 877. So, it'd be actually around 888. So if it breaks down this, the trend has failed, and there's a good chance that it may not come back. Now, if it does come back again and it reclaims the trend line and it starts to curl up again, you can always buy back into the trade. But one of the reasons why I wouldn't be risking off of B is on this particular trade, you're looking at about 11.5% loss, which for me is just too great. Now, if you're to get into this at a specific time frame and you're to buy it here, your max risk would be about 4%, which is one of the reasons why I'd be around in this area, maybe this area. But again, when I'm buying a little bit higher, whatever the percentage difference is, I do deduct that from my overall target, and keep that in mind of where when I'm looking for a sell target. I ran down based off the probabilities that I have. So in this particular trade, from here to here, you're looking at about 30%. And if I was aiming for a 30% by buying it here, I would have never actually reached that sell price. So I probably would have went for 20 to 25% sell target on this trade, just because even though it's only a few percent difference, I got to keep that in mind of where the probabilities are at, and even just that small percent of where I'll be chasing that, I need to deduct that. So CCAJ is a OTC trade. Now, the great thing about ABCD patterns is that they do form in any market, so both listed and OTCs, and they also form pretty much at any time during the market as far as time of day, and even during good market and bad market, they're pretty much consistently always there, which is one of the reasons why I think they're one of the best trading setups for a newer trader. So this particular chart, I did actually mark down ABC. And so this is a good example of an ABCD pattern of why you don't want to buy into it with the breakout of A. Most of this is the reason with OTC trades, because the potential downside, in case you're wrong, is significantly great. And with both listed and OTC trade, if there's a great enough distance between C and A, and if they fell, instead of just kind of trickling down, sometimes they can actually just drop. And I've been in situations of where, especially when I was a little bit newer and I was buying at the breakout of A, thinking I'm buying a breakout, and all of a sudden it reverses, and the next thing I know, I'm down 14%, and I'm freaking out because the stock came down to try to hold a key level, and the trade's absolutely fine. And what I end up doing is I end up taking a loss, and ultimately the trade ends up working in my favor. But trying to hold through a 14% downward loss is pretty hard, especially if you're a little bit newer. Trying to be right in the trade is something that you're always trying to strive to do. Even though that's the wrong thing to do, is to kind of think of, well, I have to be right on this trade. So on this particular pattern, what I'd be looking for is to either buy it here when it reclaims VWAP around this area, and you can buy it anywhere during this candle, and pretty much do the same thing, risk below here. So with OTCs, I do give them a little bit more room, just because their movements can be pretty fast, especially with a very cheap stock like this. So something like this, I'd be either given 5 to even 6%, maybe even a 7% risk. And if you were to buy it from there to there, you'd be, profiting about 26%, 25%, and that potential profit right there, you could easily, sell half your shares or a quarter of your shares to take a profit and try to ease some of the pressure off. So that's one of the reasons why I do suggest to not buy the top ABCD patterns as a breakout pattern. If the market does change and we're not so much in a bull market, or even slows down even more, which I've been in those type of things, oftentimes they do end up hitting A and just utterly failing. Specifically in OTC trades, where they have the potential to really lose volume, and you're kind of chasing bidders to actually try to get a fill, and ultimately you can even be chasing the bidders down and take a much bigger loss. The other thing with this type of a pattern is it's not uncommon for it to have a breakout over a key level. So let's say on this particular chart, this key level is right here. And once it ultimately breaks out of that level, it may come back, retest it, break out, hit A, come back, retest that. Now, if this level holds as support, there's a good chance that the trade can end up continuously going on the upside. And from an area right here around C to where D's at, you're looking at about a 45% profit right there. And the trend is consistently going upwards, trending an upwards trend. So the trend on that is pretty solid. I don't anticipate anyone holding to this whole upside. That'd be kind of hard to actually do, and especially when it comes down another 13%. even though it's basically just holding some support area again, there's a chance that it could potentially just crack and keep coming down. I've definitely seen that as well. The type of style that I trade, it is based off of probabilities, so it depends on what the probabilities of the specific pattern is. That's what I'm be looking forward to doing. So another great thing about ABCD patterns, they're not just great for intraday trading, they're also really good for swing trading. They have a really good, clear risk reward built into it. So if we're looking at the TBRINT, this right here is the warrants. This is a stock that I did trade recently and just sold it today. So let's say IRNT. So it has a nice clean breakout. This pre-market hours I do consider part of that of the ABCD pattern. Pulls back, starts to consolidate, and creates a low, another higher low, another higher low, and you could be buying into it, let's say around the $22.35 area, risking down here. So if you're swing trading it, you can potentially risk about 13, 14%. The potential upside on this trade, which it reached today, was 103% on the upside. Now, these do actually happen. It's part of the mentality of how traders work as far as what squeezes do. And this is a good example of where if there's enough shorts in there and there's enough conviction, people can actually push that stock up quite a bit. One of the reasons why I did end up taking a profit on this trade right here was every time I tried to sell after hours, it just wouldn't, for whatever reason, wouldn't let me get it filled. So I am taking my position off around this area, and I was looking for 30% because I haven't tracked any long-term swing trade patterns of the ABCD pattern to get any sort of probabilities. And because of that, I ended up treating it like a day trade and was just looking for 30% profit. Ended up taking a 36% profit, so I'm okay with that. And ultimately did go to $9.39. So ABCD patterns, great for new traders, built-in risk, and has an incredible reward. So if you like this content, subscribe to the channel. Leave me a comment below. I want to know what your favorite pattern is. How did you find it? And what was your favorite pattern that you actually learned from consistency with? That's pretty much it for this episode, and we'll see you next time.